Hello, this is Edgar Arceo, President and founder of the Arceo Financial Group. In today's episode is about whether or not a life insurance policy structured as a 770 account for a baby is worth your time and money. This episode was inspired by my new baby girl who was born 3 months ago. When my daughter was born, I started receiving a lot of brochures from a very well-known company, Gerber Life Insurance, about issuing a permanent life insurance for our baby. Gerber most likely sells thousands of this plan every year to new parents, and I became curious. So I said to myself, let's see what they have to offer. Some of their marketing lines were, number one, it's a great way to protect your children. Number two, level premiums throughout the lifetime of the insured. Number three, face amount or the death benefit doubles when the insured reaches the age of 18, but premium stays the same. And number four, over time, cash value grows in the policy, which can be used for any reason. Now, this last thing is what I am more interested in. I mean, yes, it is good to have a death benefit in case something happens to my daughter, but that is not really protection for her, that is protection for me. What I'm really interested in is in providing for my daughter's future so she can have enough money to go to college. Protect her from financial slavery. I want her to be financially independent of banks and financial institutions. That is the protection I'm talking about. Based on that, I applied online. The maximum death benefit that I can apply was $50,000, and they gave me a quote, a premium of $34.89 throughout the lifetime of the policy. Now that doesn't sound too bad, but what I was really interested in was how much is going to be my cash value in year 1, year 5, year 10, year 20. A few days later, I received a letter saying that my application was approved and that I needed to send my premium ASAP. This was surprising to me because how can I buy a policy without knowing the cash value? I want to see what kind of protection I'm going to have for my daughter before I buy it. I felt like Gerber wanted me to buy a policy completely blind to any cash value information. So I sent them a message asking for an illustration showing me the cash value of the policy throughout the years. The answer didn't come a few days later anymore. I guess very few ask these kind of questions. In the meantime, I kept receiving emails, letters, asking me to pay the first premium and more marketing about the policy. After some weeks, they finally replied saying that the cash value will grow to about $1,400 by age 10. So I asked again, can you show me an illustration? And they told me that I was going to receive an illustration after sending the first premium. So that was the end of the conversation. Some days later, actually, I read that the policy was going to be a MEC, which means that it was not going to be tax-free. I was going to have to pay taxes and penalties if I ever needed the money. Of course, if you don't have a lot of experience in the insurance world, you will just go ahead and pay the premium and figure this out 20 years later. So I wanted to see how I will structure a policy with the same premium amount as Gerber Insurance and what the results will be. At the age of 10, I will have more than double the cash value. And also, I will have a death benefit of $200,000. Now Gerber is saying at the age of 18, we will double the death benefit for free. So instead of $50,000, now you have $100,000. Big deal, I have $200,000 throughout the 18 years. Now, if I have the means, why not save more than just the $34 per month, which is $419 per year for my kids? Let's be honest. $34 per month will not be enough for their college education. Let's set up a policy with a bigger premium amount and see how a 770 account for our kids could work. So to keep it simple, let's set up a premium of $5,000 per year and analyze the results. I will be using a rated A+ mutual life insurance company, which, by the way, has better ratings than Gerber, and a participant whole life insurance for this example. So here we have the premiums or contributions per year. In this other column, we have the cash value or the money that the policy owner can use. And lastly, this column is the death benefit. The first year you have a cash value of $4,000. I am not going to go into details of why you have less since I have explained this before, but really quickly, this was the cost of death benefit, more than $500,000, and commissions paid to the agent. In year 5, you will break even. You have paid a total premium of $25,000 at this point, and you have over $25,000 cash value, but now you have a death benefit of $900,000. So you could say that this death benefit protection didn't cost you anything. After that, the cash value would grow at a rate of about 6%. This is using the current dividend scale, which has been one of the lowest in the last 40 plus years. I have also explained this before, but this type of life insurance companies depend on instruments like mortgages, treasury bonds, corporate bonds, etc. They do not depend on the stock market. So if interest rates start going up, they will be able to increase their dividends and vice versa. I don't know what you think, but I personally think that interest rates have to go up within the next 3-5 years. If that is the case, the results will be more favorable than what I am showing. So when the child is 18 years old, it's time for him or her to go to college. The asset or the cash value of the policy is not currently recognized on the free application for federal student aid or the FAFSA form. This will allow the insured as a college student to qualify for more financial aid than if the money had been invested in another funding vehicle. Now, what a lot of people do, they set up a 529 plan. So if you have a 529 plan and your kid happens to nail a scholarship, good luck taking that money out. You're gonna have to pay federal and possibly state income taxes on the earnings, plus a 10% penalty. But if you set up a 770 account and your child nails a scholarship, he or you can use the money for anything else without paying fees or taxes if the policy is structured correctly. So in this example, you are done paying premiums after year 20, but the policy will have a cash value of $200,000 growing at a rate of 6.5 tax-free with a death benefit of $1.7 million. Now, if that doesn't excite you, I don't know what would. The main objection I get from people is, this sounds too good to be true. So they settle with a company like Gerber Life Insurance and in turn get a pretty bad policy. All this because Gerber seems like a company that they can trust. So I just want to remind everyone that by purchasing this life insurance policy, you are not signing a contract with me or my company. You are signing this contract with a very serious and well-rated life insurance company. All companies I work with are better rated than Gerber Life Insurance and have been in business for more than 100 years, some of them more than 150 years. Compare that with Gerber Life Insurance that have been in business for just 50 years. I am the agent who will structure the policy for you so you can have the best policy possible here in the US. But at the end of the day, the final contract is going to be with a life insurance company. All payments will go directly to the life insurance company. And this is all for today. Thank you for watching and God bless you.